before we get started, I just want to make a reminder to everybody that the information discussed today is not to be interpreted or construed as investment advice. Everyone's financial situation, goals, and objectives are different. Please consult investment advice. Welcome back to the Loonie Hour, episode 8. As always, we've got our favorite boomer, the turkey man with Ice Cap Asset Management, Keith Dicker. Welcome back to the show, Keith. And then, of course, we've got the now famous Rich Diaz of Acorn Macro Research. Welcome back.
Morning, guys. Nice to see you again.
I think it's afternoon for me, but it's
it's afternoon for me too. Oops.
Early for Steve out there on the West Coast.
That's right.
Keith just woke up from his afternoon nap there, so thanks for joining us. And he actually might be stepping aside here in the show periodically to make some trades, so he's a important man. Kind of on that topic, we actually we're getting a lot of positive feedback on the podcast, so we certainly appreciate everybody's support. We were talking just before recording this. I think one of the things that you tend to, at least I appreciate in like long form content, when you just get 3 people on that are not constrained by an employer essentially or a bank or whatever, is that you can kind of say what you need to say without being necessarily filtered. So I mean, Keith, you've had a lot of experience, myself and Rich now, but just dealing with the media and stuff. I mean, I don't know if you have any sort of comments on that. Like, I just feel like you're kind of a little bit more in a box, right? If you go on like BNN, Bloomberg or something, God, we love them. But
yeah, I mean, it's changed a lot over the years. And I think what's really great about media today, I call it social media, so whatever you guys want to refer to it as. But now we have all these new platforms that are available. So, people like us, a lot of other like great people out in every world we're looking at, we're able to hop on very quickly and express our view. And we were able to connect instantly with people who are not able to connect with people in mainstream media. So if you heard someone being interviewed on BNN or Bloomberg or someone like that, I mean, the odds of you just getting that person's email or phone number or DM on Twitter, it's zero. You're not going to be able to do it. So I think it's just fantastic, but it has changed quite a bit over time. And I mean, your main point that, we can say and do and write and talk about things that we can't do on mainstream media, that you can't happen. So for example, I'm always the story guy, but back in 2016 during the Brexit referendum, I was in one of the big studios that day in one of the big cities. It was one of the big, news platforms. And so the way it works, if you've never been there, it's actually really interesting, cool. You always on TV, you see one person with the light on them and the person they're interviewing, but you have maybe 8 to 12 cameras, sound guys behind you and behind the platform that you can't see. You also have then various show producers. So for the Money Hour at 10 a.m., like that has a producer. They have to get people to interview, stuff like that. But just before I was about to go on this morning, or it was the afternoon actually, the producer came up to me and said, okay, by the way, you're not allowed to talk about Brexit. And I said, what are you talking about? Like, it's the most important story in the world today. Everyone's talking about Brexit. He said, yeah, but we don't want to be seen as trying to influence the election, the referendum and the vote. And I looked at, again, the person, well, first of all, we're in Canada. I don't think the Brits care too much they care what I'm going to say, of course, but not too much about what everyone else is going to say. And of course, I also said, by the way, didn't Obama just tell everyone that they better vote for it? Going on that route. But again, it was an example where what you see on mainstream media sometimes or read in print and things like that, it can get scrubbed out quite a bit. I think, Rich, you may have had that experience as well recently, correct?
Well, I don't have anywhere near as much experience as you and Steve do. I probably have a face for radio, to be honest. But I would say just in general, I think more sort of stepping back as my experience more generally, I think my frustrations are shared with a lot of people. Is that especially analysts, like people, we try to study markets. We love markets. We understand. I think we appreciate complexity, and I think we kind of we thrive on ambiguity. And I think that for me, not to dwell too much on it, but the frustrating thing is that it's that a lot of issues that you see, whether it's in the markets or politics or whatever, is that it's never just one thing. And life is messy. And I think instead of and I think back to what Steve was saying, I think the long form gives you an opportunity to kind of sift through all the different inputs and outputs, the pushing and the pull of the different kind of for each subject, each idea. There's lots of things to unpack, and it allows you to sort of flesh out sort of the reasons for a particular something happening, whether it's the natural gas spike in Europe, why that's happening. It's not just one thing. Life is messy. We've all, you know what I mean? It's just, that's what life is. It's different shades of gray. And I think that an opportunity to have a discussion with you guys, as well as, other podcasts that I listen to and other forms of long form media, I think that allows for that. Whereas I think the sort of mainstream media, I don't think they trust their audience enough. I think that's for me, that's the way I would couch it. I don't know, Steve, if you have a view on that.
I've got I've just got like a kind of like a funny story, but just like on the media side, because, like I like this long form podcast because, we're mostly finance markets guys, right? So you're always trying to get to you're just trying to find the truth, and you're just trying to figure out ultimately, how you can make money and protect your hard-earned capital off of that information, right? So you kind of have to keep your emotions out of it. I just find it funny because I'll go on all these media things for Vancouver real estate, but there's been so many times where I've been on invited on the local radio show, right? So they're like, okay. And so they bring you on and they're like, okay, they're like, what's happening in the Vancouver housing market, Steve? Can why, what's going? So for example, it was at the start, I think it was throughout the pandemic there. And they're like, I don't get it. Pandemic, people lost their jobs, Steve, what's going on? How are house prices going up? And I'm like, oh my God. I was like, I've got 4 minutes here to explain quantitative easing, expansion of the M2 money supply,
negative real interest rates.
Yeah. And, explain residential mortgage credit growth and how banks create, credit and blah, blah, blah. And it's so obviously, and that's not their target audience so you're just all you can do is you jump on that show for 4 minutes. You go, well, there's not enough homes on the market right now. So we have prices that are up. It has nothing to do with the money printers. But anyways, that's the way the long form content is that you're able to, and obviously I think we've got the right audience here at the Loonie Hour. We got some smart listeners. So
I think it's listener, isn't it?
Yeah.
Your mom or my mom?
My mom definitely listens every week, just for the record.
Tell her we need a review here to boost our SEO juice.
But other thing but let's just jump in as well. The other thing that's really great today about these different platforms, on Twitter especially. I remember a few years ago, this person I did not know tweeted another person who I knew of, and so it was Raul Paul, the Real Vision guy, and he said, "Hey, we should get IceCap Global on your show." And he's like, "Good idea. Who is he?" And the other guy said, "I don't know. I have no idea." Right. So, and it turned out that guy was, we're best friends today. We're quite good friends. And, but that's the way it works now. For example, I did a podcast yesterday with the guy, Bradford MacArthur. He's in Squamish. So Steve, just not too far from you.
Yeah.
And so he and I, he has a really cool broadcast. Podcast that he's doing. I encourage everyone to check him out. It's called The Emperor's New Clothes. I think that's the name.
I was on there too.
Yeah. So we're chatting, a great conversation. He's such a nice guy, super guy. And I said to him, how far out from Vancouver are you? He said, about 45 minutes to an hour. I said, hey, when I go up there next time, I said, I know another guy there. We should get out for a pint or something. He said, yeah, with Steve, right? I'm like, yeah, absolutely. So again, I didn't know, Steve, that you and he were friends, and then he and I are, but it's just the way everything gets connected together. And again, with the whole social media platforms today, I know a lot of people are interacting with us And it's really great because we expand our networks, and you literally have like a 24-hour clock going with your network all the time. And again, it's just outstanding.
Well, speaking of connected, as always, we're going to try to connect markets for everybody here that's listening, because we had, a decent news week. Keith, I know you, Rich is getting ready here. We had Jay Powell come out to testify there, and I know he's now dropped the word transitory, so big win for Rich there in his portfolio. But yeah, I mean, definitely a nice pivot there from, Powell the Dove to, he's getting quite hawkish now, right? I mean, they're talking about accelerating the taper. So, Rich, I don't know if you want to take it away first and foremost, because this is you've been beating this drum for a while now.
Yeah, so I'm going to take a small victory lap. There you go, victory lap over. I don't take any, in some ways I love being sort of right about this, but in other ways I think it's really shame, right? At the end of the day, inflation's bad for working class people, and although it's fun to be right about it, at the end of the day it's meaningful. It's meaningful for people who don't necessarily have pricing wage power, and it's meaningful for people on fixed income who might be of a certain vintage. And so although it's fun to write about it and to sort of to see it come through as you sort of predicted, at the end of the day, it's the rubber does meet the road. There's real people's lives, I think, that are impacted by these policies. And I think, an homage to Keith's sort of pragmatism, I think it's important we sort of just remember that. So I think it's quite sobering. But basically the reality is, not the reality, but the headline is that Jerome Powell and then subsequently Janet Yellen, and I think I'm quoting them correctly, they want to retire the word transitory. I think in April or June, I forget now, the months are all sort of blending together. I wrote a note called "No, it's not transitory," and my issue was that the following reasons, I can lay them out now for you, and I can share this note that I've written for people, but it's debt, demographics, and ultimately it's policy. It's, we've just talked about this before in the past. It's financial repression. The only way that any of this debt gets paid back is through having inflation well above interest rates and sustaining that. I think it's important to remember there's a demographic thing, and maybe we'll get into wages later, but I think the demographic situation definitely impacts that. I'm not going to digress in there. And the other thing I think is important is the shelter component, which we've talked about. I'm not getting into that. But basically what it comes down to it is that Jerome Powell has effectively admitted that inflation is going to be higher for longer than they had previously thought. And they want to sort of move away from the word transitory. And the upshot for investors is that he has said that they're willing to move forward any tapering, which I think is negative for some people, positive for others. I think some people are going to be happy to call their bluff. But what does tapering mean? Tapering means tightening of monetary policy. So reducing bond purchases even further and bringing forward or accelerating the pace at which they reduce bond purchases. Sorry, that's a mouthful. I think, and Keith, did I get that right?
Draining liquidity. So yeah, Keith, do you want to touch on, I kind of want your view, Keith, here, as a market guy, on how successful this is going to go, because we've, as we'll get into in the show, the turkey man, we're seeing some turbulence already, and we're seeing obviously, a bit of an equity sell-off here. So, I mean, Powell's getting hawkish. What's your view on how this plays out? Because this has, and again, just to reiterate, because we know this is a Canadian focused show, the Bank of Canada basically takes their orders from the Fed. So the Fed is the U.S. Fed is the most important central bank. So it directly affects or impacts our interest rates here in Canada. So Keith.
So this week was incredibly important from our perspective because it signifies is a pretty big dramatic turning point. So as investment managers, we're always looking, to zag when everyone is zigging and zigging when they're zagging and stuff like that. Now that we have the Fed admitting that, hey, inflation is a challenge, we're no longer going to try to hide behind this, transitory phrase, and we're going to start becoming hawkish. We love this because now what this is telling us, now the countdown is on until a crisis does develop in the emerging market world. It's happening. As of yesterday afternoon, the clock has started to tick. Now, whether it's measured in days, weeks, months, or a couple of quarters, it's not going to take very long. But as soon as this now starts to develop, all of a sudden it's really going just to start to suck the energy out of the emerging market world. So capital is going to start coming out, it's going to start flowing into the dollar, flowing into the treasury market, and so forth. And then what it also does, all of a sudden now the Fed is saying, yeah, inflation's a problem. Now the BOC says, yeah, inflation's a problem. Everyone else says inflation is a problem. What I'm sharing with everyone right now, our listener, of course, is that, hey, the next big shock coming up is that inflation won't be a problem. So what I mean by that is the dollar gets stronger, is the Fed, if they try to become more hawkish, reduce QE, slow it, and maybe even try to raise rates, this has potential to create this deflationary shock to the system in the market world. So for example, one thing we look at, of course, is the yield curve. The yield curve is flattening. People say, what the heck is that? It means that the difference between short-term interest rates and long-term interest rates is getting smaller and smaller and smaller. And you might see that out there quite a bit, and different media platforms and so forth. But there's another sort of yield curve that we look at as well. It doesn't get any play whatsoever. One of the guys, Jeff Snyder with Alhambra, he's down in the US. He talks about it all the time. But the overnight rate in the euro-dollar market, so from 1 day to 3 days to 5, 10 days, it's a very short time frame you're looking at. Even that is starting to invert. So as soon as you get an inversion of the yield curve or flattening, it's telling you, hey, growth is going to slow. And then when that happens, and that's when the naughty things start happening in the market. So from our perspective, I think it's great that Powell said that. And it does signal that we got a big turn coming up in the market. Now the fuse has been lit. And that's just great from a market perspective. Now you know what's going to happen.
And Keith, my opinion of your comments, because I know you fairly well, but I think that you're the stance still, because when you say what you say, I think there's a lot of people that get things confused. So there is just some people I think that might interpret that as that okay, well, the Fed's really going to hike rates and we're going back to this rate normalization period. But correct me if I'm wrong, but your view is basically they're not going to get very far here without triggering again some sort of event in markets.
Yeah, absolutely. I mean, the way markets work is always, you buy the rumor, sell the news. I mean, we've talked before about, will the Bank of Canada get 8 rate hikes in? And, all three of us, we all agree, it won't be 8. They might be lucky to get 2 or 3. But that fuse has already been lit now, with the biggest guy in the room saying, yeah, we agree, we're going to start to tighten in various ways. And so, the markets will begin to adjust for that. And when they do start to hike, and again, I don't think they will get to hike at all in the US. I think it's going to be a shock if they do it. But the fact that they're saying, hey, that's where we're going now for certain. And what, of course, leads to a conversation from last week is that, this is setting up for a market event. And then Powell decides, all of a sudden he has an account in Panama that he didn't report. And he's invited to leave Washington, and the new chair comes on. And they become dovish, of course. That's where they want to go.
So can I just jump in there? So I think I have a slightly differentiated view than you, Keith. I think that's, although I agree with sort of the layout, I don't think that demand and growth is as weak as I think people think. And although I can see the potential for a deflationary shock, I also see that there's actually room for there's still a lot of pent up demand. And I think that, people are still, I was in the US last week. Everybody is out. And I think that, and like the stadiums are packed. People want to travel. People are cashed up and they want to move on. And I think that we can't sort of, although I think that it's important to recognize, Keith made a very, succinct point with respect to Powell and, buying the rumor and selling the fact. And I get all that. However, I think it's important to recognize that, there's some technical indicators that are important here too, right? We're ending, the year's ending, the market was overbought. Sentiment was really, really quite bullish, which is a contrarian indicator. People want to protect their bonuses towards the end of the year. And, you're in a situation where the market was almost, I think, ripe for a catalyst. We wrote about this in our asset allocation strategy a couple of weeks ago. And, along comes this Omnicom thing, which I think we can't discount, or Omnicom. I can't remember the name of the new variant, but we can't discount that. And I think that's so maybe where Keith and I might disagree is I think this actually provides cover in a way, this, and so go ahead.
So just to add to that, and when I say that this is going to change, like the turn is occurring, it's not from within the U.S. Remember, the U.S. is the core of it's the center of.
Sorry, my
Rome.
mistake.
It's Rome, and as we all know now, Rich was down in America last week during the biggest shopping season of the world. So of course you saw people out, having fun Thanksgiving week. Our view is that all the trouble, it starts from outside the U.S. That's where it starts. And, the U.S. has always been, beating to its own drum, that's for sure. But again, we keep going back to Canada all the time as well. Like the challenge with Canada is it's not inside of Canada. It's going to be this external shock that will come along. So like for your view, Rich, like when you say, hey, the U.S., it's pretty strong, and it is, right? It's really good. I see all the same things that you do as well. And, but for that reason, if the rest of the world starts to weaken first, whether it's from financial conditions or geopolitical risk that's happening or funding costs and so forth, it just makes the U.S. even more attractive. So I think the U.S. data points will be the last one to start reflecting any kind of deterioration.
I guess so. But I'm sorry, one last thing. I just think for me, it's, my job is, I think it's fun because we get to contrast our constraints, right? Keith is, I think, if I may say, a little bit more short-term because he's actively trading. He's got particular goals to meet in the near term. And for me, my clients are much more long-term in nature. And I think that allows me to sort of look past, I think, this noise, and I also frankly don't have mark-to-market losses that I have to worry about. And so for me, it's like, and also the question is always, do you want to buy stocks or do you want to buy bonds? I mean, that is what dominates 90% of my thinking. Because and for me, for my clients, that's the most important thing. You can worry about tech or energy or financials or consumer staples or whatever you want. But if you're overweight bonds when you should be underweight, all that stuff doesn't matter. And so for me, 6 to 12 months out, do I want to own those stocks or do I want to own those bonds? And for me, the math, although it's getting cloudier, I still think for me on my end, it still hasn't changed. I don't see how bonds return any money in real terms. Whereas I think the valuation, the earnings outlook, the expectations for earnings have been absolutely drilled to the floor. You get a shakeout towards the end of the year, and I think you can actually have an opportunity if, as Keith points out, they back off from their hawkish stance to have sort of another leg up. And that's why I think it's fun to talk to you, Keith, because we do have we have different lenses and we have different sort of time horizons.
You guys can fight it out later in the parking lot. But no, I do think that definitely matters. Time horizons, I think, is everything. Is people always get confused, and I get this all the time when I talk about like the housing market, even, right? It's just like, oh, you said this, and I like, listen, I said, anyways, it's all just depends on time horizons. But Keith, I want to get to quickly on Turkey as well, because there's been some updates there. People that have been listening to this podcast, if you tuned in a couple of weeks ago, you might have made some money off Turkey, so you can send a gift card over to Keith there at his mansion. Keith, what's the latest there? It seems like it's brewing into a bit of a crisis now.
Yeah, unfortunately for people over there, it continues to deteriorate. So it's the same thing as happening. Foreign capital is leaving the country, so the currency continues to weaken, which means inflation is really high over there. Now, mind you, like the inflation that we're experiencing over here is because there's a lack of supplies coming in. The other way to experience inflation is have your currency depreciate rapidly, and that's what's happening there. The central bank, they have negative reserves. So again, we mentioned before, the central bank is taking dollars from the commercial banking system. They also have a swap line with Qatar, I believe it is, and so they're the last 2 days they've been dramatic, like spending so much money selling dollars, buying lira to try to stabilize it. And they can only do that, it's hours that they can do that for, and then the crisis will resume again. So, I mean, the only way to save this in Turkey right now is really for the Fed to step in and say, yeah, we'll give you a swap line as well. That would dramatically change things. But behind the scenes, there's a whole lot of geopolitics taking place. So the bottom line is that as Turkey continues to deteriorate, and if the rest of the world starts to say, yeah, risk off is now happening, people say, well, there's no contagion taking place. What it's kind of irrelevant how you would describe it. The point is now you get, 1 + 1, could equal 3 in terms of risk coming off. So like everyone, continue to watch this Turkish lira story, because the effect for Canadians is that it could cause credit spreads to widen. That means it becomes more expensive for you and I to borrow, whether it's in the housing market or with any other kinds of lending. But again,
that leads me.
Yeah, like this whole Turkish story. We've been following for maybe 2 years ago, and about a year ago, we put out a paper about it. And that's my point with these big turning points. I think they're incredibly easy to identify. And I think you can be right, 75% of the time. You don't know when it happens, but it's going to happen. And that's Turkey. Then it goes back to, of course, now, as I said earlier, with the Fed turning hawkish. I think that just, it's just a matter of when, not if, we get this other pullback.
Well, that brings it to a next good point here, because just to connect all the dots for you guys, as Keith mentioned, his mic's levitating here. You got this situation where credit spreads start to blow out a bit in Turkey, and that sort of ripples through over to parts of Canada. But one of the ones I wanted to highlight here we talked about pre-show was municipalities. So, for example, where I am here in Vancouver, it says, this big headline out: City of Vancouver's shaky finances and spending levels could necessitate a 10% property tax hike in 2022 and an average 7% property tax increase for the years from 2022 to 2026. So basically saying, hey, Keith, you're going to touch on this in a sec here, but I think the point is that I flagged as like, man, these guys are having issues, financial issues with their budget at a time when house prices have never been higher, and interest rates have never been lower. So you can imagine, right, if the city of Vancouver's borrowing costs, God forbid, should start to increase, it just makes the problem even worse. And again, these property tax increases are just a tax on consumption. They're just a tax on the consumer. So Keith, I don't know if you have any, you can explain maybe like the municipal governments, like, correct me if I'm wrong, but basically they're not allowed to actually run deficits.
Yeah. Most cities, maybe it's some jurisdictions, they don't have this, but it's my understanding, maybe people can send us a note if this is right or wrong, but it's my understanding most municipalities, they have to run a balanced budget, by law. And that's part of the provincial law. The province, of course, can run a deficit if they need to. So if a city runs into problems, say, hey, we need a bailout or whichever way funding, it'll get funded down to them from the province. But the big challenge we have coming up here now is that cities, like their expenses, it's expensive to run a city. You have labor costs are going up. the cost in Canada. So snow removal is going to go up because most of that is contracted out. You name it. So they need to raise additional revenues, and the easiest one in the world is a stealth tax increase. Instead of raising property taxes, they'll reassess the value of your home, or they raise the cap limit of what can be taxed. And as soon as that goes up, like we pay probably 1% property tax where I am, and it's a big tax bill every year. And so say you're anywhere from, say, 0.25% up to 1%, and on an absolute dollar level, it's going to be a pretty big increase, which means there's less money available at the end of the day to spend on other things. And if energy prices keep going up, that's more money that you're pumping into your car and stuff like that. It's not positive for the economy. So the economy has to continue to boom along. And then if, the Bank of Canada, if they're raising rates, as they say, and stuff, again, it's kind of tough right now. Bottom line is there's too much debt out there. And if rates go up, it's going to be hard for these guys to service it.
Yeah. I mean, everybody always talks about Canadian households. And I say, well, look at your municipal government, look at your provincial governments. Obviously, we know Daddy Trudeau there is running massive deficits, which Rich has eloquently highlighted in some of his charts there, which the Bank of Canada is now essentially funding. So yeah, the debt picture, I think globally we've got $300 trillion worth of debt that you gotta roll and refinance basically to sort of keep the system going. Rich, I don't know if you got any comments there.
Well, I just wanted, stepping back again, just sort of, taking sort of maybe pulling away from the immediate. I was just wondering, my view is that shouldn't property taxes go up? It just seems like who owns property? Old, rich people who, I'm being totally serious, right? Like, we've had a massive boon to asset holders. What are those assets? Houses mostly, right? So I think 60-70% of there's a 60 or 70% home ownership rate in Canada. Your house 69. Price. Yeah. So your house prices have gone up 20-30% in some cases, 50% in some cases through misguided monetary policy. The idea that you wouldn't sort of hand that a little bit of that back when you've made out like an absolute bandit. In other countries, I think, and then there's the whole money laundering stuff that happens in Vancouver. We're not allowed to talk about that, of course, or else we're going to get banned. But there's a lot of, and the idea that you can't move that capital, right? So the problem with, Elizabeth Warren, God bless her soul, she wants to tax capital gains. I think that that's obviously ridiculous, but, and people want to tax wealth. Well, you can just move wealth. You can't move property. And I think that that's so in a world where debt is really, really high and there's significant asset inequality and rich asset owners have made out like absolutely crazy because Justin Trudeau and God bless the Bank of Canada, how else are we going to square that circle? And to me, raising property taxes seems like an eminently sensible way of doing it. So I get the demand, it'll hurt demand, at the margin, but I have yet to hear a better idea.
I think what they should be doing is which again, obviously they won't, because when does the government ever lower taxes? But you lower your income tax and have higher property taxes. Obviously it makes sense if you're looking to balance inequality, right? Because then you're
incentivizing work. You're
incentivizing,
but that's exactly my point.
Productivity.
There's houses in Vancouver that are worth tens of millions of dollars that are sitting empty, and the idea that you wouldn't raise property taxes on those houses in order to pay for services, to me, I really don't quite see the ethical, moral, or economic justification to push back against that. That's my view on that. So, but like Keith says, we shouldn't worry so much about what should, we should worry about what is, and what is those taxes are going to go up and it's going to hurt demand in the near term for sure.
I'm still wondering if that Trudeau government ever, still mumblings about it, if they ever do end up taxing your primary residence and removing that exemption.
Never going to happen.
I think Steve and I might have a conversation about getting rich off the show for suggesting that it's going to be. So I have a bit of a different view than that. I mean, you can't, just because someone's house has increased in value, it doesn't mean that they should pay a bigger share of tax. There's two reasons for that. One is that just because the value of your property is increased, it doesn't mean your income is increased. So let's just say your house went from 1 million to 10 million for whatever reason, and they kept it at 1%. All of a sudden, where are you going to get the cash to pay that tax bill?
But they won't do that. That's a straw man. I mean, that's a straw man's argument. They're not going to raise it.
No, but that's an extreme point, though. But like a lot of people, just say somebody had a $200,000 house and now it's worth $250,000, okay? And say all of a sudden their tax bill has gone up by $2,000 for the year, right? Or 24. That's like $200 a month. Let's say that. That's a lot of money for some people. And again, so I disagree with the private sector having to take on the liabilities of the public sector, because that's what it is. It's not that, hey, we should tax property because it went up in value, or tax the assets of the private citizens because it's gone up in value. What's really happening is that the public sector is saying, you know what, we have no idea how to control our expenses. We're always spending beyond our means. We can never allocate capital efficiently. So because we're really not good at that, the private sector, you have to pay for that. And I disagree with that.
So when you put it that way, I totally agree. However, taxing incomes also, like Steve's point about income versus assets is 100%. We're disincentivizing Canadians to work. Why work when you can just borrow money and invest in property and you never, ever get taxed? And I think that's, we're in a situation where those two things, Keith, I agree with you. Of course, I'm a markets guy. Please don't kick me off the podcast. But there's two things that are coming up, there's, an immovable, what is it? An unstoppable force and an immovable object. I mean, you have a situation where you cannot keep taxing and disincentivizing income. And
I think though, but that's a good point, Rich. I think though, ultimately, like that's where we're headed, is that we're talking about the current system. It doesn't work.
Right. Agree.
If you have to raise taxes, and again, I completely disagree with whatsoever. I would be taxing income and not asset values, because at least if you're taxing income, you make the assumption that, it's going to be a lower percentage rate, and you're making the assumption that someone's income has risen, or they're going to raise on the tax bracket in terms of the income bracket, sorry. But the main point here, we're swimming through the weeds. The main point is that the system doesn't work. There's too much debt at the federal level, too much debt at provincial level, too much debt at the municipal level. And so what's really funny? So think about this. So, everyone, they got to follow tax returns every year. A lot of people have to get help to do that. I run a business, so I have to get that done. I run a regulated business, so I need audited books done. So if you just think about all the cost that goes into tax preparation, tax planning throughout the year, it's an incredible amount of money. And what's the value added of that to society? Now, I have lots of friends who are accountants and CPAs and stuff like that. They're saying, well, Keith, we need to buy, a house, in Vancouver next to Steve Saretsky and all that stuff. But my point is that there's going to be a different tax system coming up. And whether it's like a zero. So for example, I lived offshore for a long time and we had zero income tax. And people say, oh, well, like, first of all, that's awesome. Lucky for you, because we pay 40% in taxes. However, where I lived, we had the biggest consumption tax, and it was hidden. It was like everything that got
import duty, right?
Yeah, import duty. So the loaf of bread, that's, say it's $2 here. It was like $8 there, right? That's what it was. So even though there was no income tax, it was a consumption tax. And that's the way maybe the tax system should be. If you're big and wealthy and you're buying stuff all the time, then, by default, you are, paying more in taxes. Whether if you're lower income, you go that route. Here's a good story though, again, I love stories.
You get really rich there, eh? If you don't eat your avocado toast.
Yeah, absolutely. So one day I was in the grocery store, and it was wintertime. And so I was in Bermuda, by the way. That's where it was. So like mid-Atlantic, not not like in the Caribbean. So the winters can get quite cool. And we actually had a fireplace in our house. And so wintertime, you're thinking, boy, I like to maybe have a fire tonight because it gets really damp. And I'm in the grocery store, and the grocery stores are the ones. Remember you guys don't remember because you're young, right? But the old days, they had the sticker gun. They put a sticker on everything for a price. And a lot of the stores down there, they were still like that. And I'm at the cash ready to check out my groceries, and I see this like pile, like armful of firewood on the floor, like wrapped up with some string. I'm thinking, oh, that's exactly what I need tonight. So I pick it up, and I'm in the line. There's no price tag on it, and I'm thinking, wonder what this is going to cost. And I said in my mind, it's probably $60 to $80. That's what I'm thinking for like 10 pieces of wood. Yeah. So I'm there and I'm waiting, and I keep going back. What is this going to cost? Everything, will my wife will she like this or not? And she all that. And finally, you come to the cashier, and I plop the wood up, on the desk, whatever. And she goes, "That's $45 for the wood." So think about $45 for 10 pieces of wood, whatever it was. In my mind, I got a deal. That was outstanding. But back to consumption, though. But back to consumption, right? Yeah. I think there's different ways that we can do it and not go down the property tax and income tax route.
So, but just one thing, being a pragmatist, I think this is why for my clients and when I write about asset allocation, financial repression continues to be the driving force for all of my decisions regarding investment. The other way of dealing with it, when you have a government that's feckless and unwilling to sort of tell its citizens that they need to change the government needs to change its consumption patterns. So I agree with you, Keith, that I don't think the government's necessarily good at allocating capital, and they clearly haven't demonstrated a way of being responsible with their the money they do have. And then the way that you square that is financial repression. You sustain inflation above interest rates for a long, long time, and ultimately your debt to GDP falls. And I think that's for me that, when I'm speaking to my clients, it's what drives what I put on Twitter. It drives the conversations that you guys, when people ask me, Rich, what do I want to own? For me, that's why it's the other way of doing it. It's the other way to square the circle.
I mean, I'm big in the financial repression camp. I think that, it's funny. I had a coffee the other week with like a political strategist, right? And like, not that he needed to tell me this, but it was kind of interesting. But he's like, every one of our surveys, like every bit of our research suggests that in Canada, and I'm sure this is probably true around most of the world, is that they want bigger government. They want more government, which is interesting because that comes back to
it's because they've never lived in a communist country. It's too nice here. Well,
it comes back to
ask anybody who grew up in the 80s and 90s in Eastern Europe. Ask them if they want a bigger government.
Right, but I feel like inevitably, as market people, that's where we're going, and so taxes are going to rise to compensate the public sector. Mm-hmm. And we're going to need higher wages, which, speaking of, as we've talked about on this show, our good friends, congratulations at Cargill. That's the meatpacking factory or whatever in Canada there. I think they're like, they manufacture like 2/3 of all the beef here or something, but they got a 21% pay raise over the life of their union contract, which I think is like 4 or 5 years. So, and then we've got the in Vancouver here, the truckers at the port of Vancouver are set to go on strike this Friday. Looking for higher wages. Everybody wants higher wages. So I know Rich has been a little bit focused on this inflation and wage price spiral, right? I mean, cost of living is clearly going up with governments demanding, higher property taxes, et cetera, et cetera. CPI inflation is high. Asset prices are roofing. So in order to even get this remotely sustainable, you have to have higher wages. And I think we're starting to see that come through. But
So if I can take this, so this is one of the pillars of my "No, it's not transitory" article that I wrote. And I think there's two things going on. One, of course, it's the ridiculous policies. That's the short-term kind of impulse, which, Keith and I are stupid. Longer term, I think what people don't think about enough is the age dependency ratio, and the fact that there's just a natural kind of attrition with respect to the number of prime age working people relative to the people who are either young or the people who are very, very old, who are retiring. And you're starting to sort of see that bite. From the 1960s all the way to 2000, you had a massive influx of people in that prime age group of workers effectively. So think about, one in, one out. Well, if you have, supply and demand curves, they drive everything. It's beautiful, as I love markets, but anyway, you just had a big sustained increase in supply, right? Think of the baby boomers and think of the ripple effect of that. And now it's sort of the opposite. And very few parts of the world have a growing prime labor force. And in the West, in Europe and in Canada, minus immigration, and the US, you're starting to see sort of the opposite happen. And you're having, that's for me, it's really fun to think about those kind of longer term impacts. But Keith, what do you think about the shorter term? I'm sure you have a view on the shorter term stuff.
Yeah, absolutely. But it also sort of, references back to what Steve was talking about a bit. So, you can look at what percentage of the economy is coming from the government, what is from the public sector versus private. And I think in Canada right now, I'm sure Rich knows the number, of course, you're the numbers guy, but we must be close to 50%.
Oh, I don't think it's
over
that
50
high.
or just below.
It's not that high. It's not that high. It depends how you calculate it. I know you. I know. Yeah. But anyways,
but the French, for example, the French have one of the highest. A lot of the European countries, the highest numbers in the world. Canada, we're heading. That number is heading towards that same direction. And as we go increasingly more towards socialism or more stronger social policies, and it doesn't matter whether you're for it if you're receiving it, you're against it if you're paying it. And the point is, though, that as that begins to happen, the country becomes less productive, less efficient. So then you have to try to make up for that in other ways. And in Canada, I mean, like the biggest part of our trade surplus that we produce in our current account is from the energy sector, and we already talked about that. That's declining. I mean, that's getting whacked. So has Canada been prepped properly to prepare for other ways for production of the economy? And we haven't at all. It just hasn't happened. So then you go to other countries, like to the US. I think they continue to have some of the best demographics. They continue to have some of the best rise in like technology, innovation, and healthcare. You name it. Like it's a lot stronger there relative to Canada and the Europeans. So we can have a bit of a negative view, I think, where things are going to go. However, we have an extremely positive view on that. As things get negative elsewhere, boy, oh boy, the U.S. is going to be the landing spot for all this money, running either to maximize return or from safety of capital. So these are big changes that are taking place.
Canada's got the 3 C's, right? Condos, crude, and cannabis. And we're just about to lose crude, so we're down to 2.
So just to touch on the energy thing, what's really cool actually, I shared the chart on Twitter the other day, is that Canada's finally closed its current account balance, which is reason.
Can you explain that
So current account balance is basically comes from 3 or 4 places. It's effectively it's trade plus, and then the plus is primary income. And secondary income, and those secondary incomes usually certain like transfers. Canada doesn't really matter, but think countries like Mexico and the Philippines, where transfers are an enormous chunk of thing, and it's effectively flows, and you can fund that flow via inflows of your capital account and your financial account, your current account, which is like trade in goods, services. Primary and secondary income need to more or less balance with your your financial or capital account with some sort of error term, and that error term is the change in your foreign exchange rate, right? And Canada's current account, so that's the trade balance in services, your trade balance in goods, your primary income and secondary income. And like I said, those last two aren't really that big a deal, but they do certainly contribute. And so Canada has finally closed, so to speak, as in it's now zero, its current account deficit. And I just wanted to remind everybody that it's all energy, because if it wasn't energy products, our current account balance would be super, super negative. And sorry, you guys are laughing, but I just wanted to hammer that point home because I got a lot of good response from that. I'm sorry.
I feel real bad for Steve Saretsky's mom and my mom, because they're not going to know what the
God bless them.
So I thought I did a decent job explaining that. Well, I don't know.
It was good. I followed it.
I know that's a technical kind of thing, and we shouldn't spend too much time on technicality. So we can skip.
You're saying to buy gold. Good news. I now own more gold than the Bank of Canada.
Oh yeah,
I bought 1 ounce. So I went up to the teller. And I've never bought like physical. I went up to the bullion or whatever it's called, and man, what a disappointment that was.
I own 1 gold coin too.
I bought this thing. I was like an ounce of gold, right? It was like $2,400 Canadian. Yeah. And he gave it to me, and I was like, "Oh, this is it." Like I was hoping I was get like one of those like bars for $2,400, and it was just this little.
No.
Oh, it's pathetic. So I think I'll just stick to my crypto, but I think that's probably a good way to wrap it up. Loonie Hour episode 8. As always, we appreciate your support. Just to give us some SEO juice in the podcast platforms, if you can hit thumbs up or rate and review the podcast on Apple and Spotify. Or what have you, subscribe. It certainly gives us more front of page views, et cetera, et cetera. So as always, we appreciate the support, and we'll see you next week.